But because have been living in capitalism, and the importance of the debt in basically assisting in the growth of the economy, the importance of the bond market, and whatnot. So in your simulation or in your view, what would be the accepted level of private debt to to the GDP and whatnot?
I'll go into some of that empirically later, but I think the basic level that I think is, if you think about a debt-based system or even an equity-based banking system, anything over 75% of GDP as a debt level is...
Malaysia is having about 55, so are we still okay?
Pardon? No, in fact, I want to show you, I might actually go across and show you that right now if you like, because that's another part of the presentation I intend doing today, but I'll bring up a little illustration of just how much trouble we are in with the level of private debt right now. If my computer would only respond to me. Let's see, hang on. I've pressed 3 times trying to get the File Explorer. Here we go. We're now going to get 3 copies of File Explorer. Wonderful. But I'll just bring up a little illustration I've done here. Because that whole question of just what is a sustainable debt load for an economy is an extremely important question. And fairly recently, a guy who's an American philanthropist who was a banker did an empirical study. His name is Richard Vague. He has a book called The Next Financial Crisis and How to Avoid It. But he did an empirical study of the last 1.5 centuries of economic crises around the world, about 150 crises over that 1.5 centuries as it happens. And he said every last one had a debt level of more than 1.5 times GDP and a growth in that debt level over the previous 5 years of 17% or more. So the ratio going, say, from 1.3 times to 1.5 or 1.5 to 1.7. Malaysia, according to the Bank of International Settlements right now, is running about 1.48. So I just want you to see this little demonstration I've built here using Bank of International Settlements data. And you can see, I'll just go right back to the, let's hope that works, okay. I'm going right back to, let's see how far the data, okay. So I'll go back to 1965, and got a range of countries inside. You can see the United States sitting there. So the size of the circles is the level of GDP growth, nominal GDP growth. The horizontal position is the private debt to GDP ratio, and the vertical position is the annual change in private debt as a percentage of GDP. Now, the higher that is, the more you're going to accumulate debt. So a high level here means you're going to go in this direction. And I've marked off what I see as the danger region, the level of private debt, above 1.5 times GDP, and with credit, which is the change. I define credit as the change in private debt. Okay? So I use debt and credit quite separately. Debt is the stock, credit is the flow. Okay? And if I now run this over time, I want you to, you'll see Malaysia's in here somewhere, it turns up at some point. You'll see it ends up getting in a fairly, it's been through a dangerous position level already. I think it's about to approach that again. So I'm now going through each year's data on a month-by-month basis. You can see Japan is the first country approaching this danger zone. And of course Japan had its crisis back in 1990. 1967, A68. Pardon the jumps and the visual, that's the flaw with Microsoft Excel every time I change years. Now, the late 1970s to early 1980s is when Japan started to get into what we call its bubble economy period. And you can see it passing in there in the early 1970s. It has now hit that 1.5 times GDP ratio. You saw Singapore popping up there occasionally with a much lower debt level. And now, in the late 1970s, Japan well and truly moves into that region. And they have what they call their bubble economy period. Notice a number of countries that end up having financial crises later, like Portugal and the Netherlands are turning up there. Here comes the 1980s, and you'll see Japan goes right into that region. And when you first pass into this region, when the banking sector is really taking over and funding a whole lot of Ponzi financial behaviour, your economy appears to take off.
I saw Hong Kong go way up there.
Yeah, I know.
Didn't they have a crash? The stock market
They did, yeah. So we're into the 80s. Now, watch Japan. Just fly up here as 86 to 90 goes on. Norway, Denmark turn up as well. They had financial crises at similar times. Here goes Japan and Hong Kong. And now Japan hits its crisis in 1990, and it'll fall down out the bottom of that box. And when the circles turn blank, that's when growth is actually negative. You notice the Asian financial crisis approaching now. Korea, Hong Kong, Thailand, Malaysia, all start to enter that region. Japan is falling off the edge, as you can see. Credit growth now is becoming virtually negative. Here's the Asian financial crisis, Thailand, Korea, Hong Kong, and Malaysia.
This is the point where Finland actually falls below the negative region of the percentage private debt to GDP, so that means that private debt are not...
It's falling, yeah. When it's below here, it's negative. You now see Japan and Hong Kong have both had the crisis. And all the Asian financial crisis countries are now down here with negative economic growth and credit actually negative, falling rather than rising. Now we see the United States starting to move into this region. And Ireland. You'll see Ireland has some remarkable explosions in private debt. Portugal, all the countries we're watching having crises right now. There goes Ireland, what we called the Celtic Tiger at the time. Spain, Norway, Hong Kong, Sweden is in there. The United States is now entered. It's now falling out the bottom when the crisis hit. Ireland is hugely negative change in its GDP. That's the crisis itself. And now we see China and Hong Kong moving in there because their response to the financial crisis was to stimulate private borrowing. And that is Spain, Portugal, Hungary, Greece, down the bottom, negative credit. So change in private debt actually taking demand out of the economy rather than adding to it. And now we are approaching modern day. Oh, the data's disappeared. Great, now it's back again. Okay. So the countries that I see being in danger are obviously the ones inside this region: China, Sweden, Hong Kong, Australia, Korea, Canada, Belgium. But notice Malaysia, Thailand and Singapore are all coming back into this region again. So I think actually Malaysia is in the danger zone, or moving in that direction. You have several years where you can get away with it, because while the credit's expanding, then you can get a boom in the economy. But when you get up to this level and you start to have a decline in the rate of growth of credit, that itself drives demand down, and then you end up crashing out the bottom. So I think you're actually in the danger zone.
I have two questions that let me invite.
Yeah.